Welcome to Global Byte. Please subscribe and hit the bell icon for more breaking updates. A storm is brewing over the global automotive industry, centered on a once stable partnership now on the verge of collapse. The US-South Korea relationship, once a pillar of economic and geopolitical stability, is fracturing under President Trump's America First trade agenda. For Hyundai Motor Group, a titan that invested billions in the US, the ground is shifting. Mutual prosperity has devolved into high-stakes brinkmanship, tariffs, and immigration raids. This crisis is more than a trade dispute. It's a clash of economic nationalism and global integration, with consequences for supply chains, alliances, and the very principles of the world economy. The US-South Korea economic partnership began as a beacon of post-war recovery and international cooperation. In the aftermath of the Korean War, the United States played a pivotal role in rebuilding South Korea's shattered economy, providing not just financial aid but also technical expertise and market access. This early collaboration laid the foundation for decades of close economic ties, transforming South Korea from a war-torn nation into a global industrial powerhouse. The relationship was further cemented by the landmark 2012 Korea-US Free Trade Agreement, known as KORUS FTA. This agreement was hailed as a major achievement, opening up new opportunities for businesses and consumers in both countries. By eliminating tariffs on thousands of products, the pact fueled robust growth in trade and investment, while also deepening the strategic bonds between Washington and Seoul. Industries like automobiles, electronics, and agriculture flourished, and the agreement was seen as a model for future trade deals. However, the arrival of President Trump marked a dramatic shift. His America First ideology recast trade agreements as threats to U.S. jobs and sovereignty, rather than as engines of mutual prosperity. The KORUS FTA was quickly singled out for renegotiation. The U.S. demanded stricter terms, aiming to reduce its trade deficit and gain more favorable conditions for American industries, putting pressure on South Korea to make concessions. Tensions escalated as South Korea struggled to protect its export-driven economy in the face of unpredictable U.S. demands. The uncertainty rippled through industries, affecting workers and businesses on both sides of the Pacific. The trust and predictability that once defined the alliance began to erode, replaced by anxiety and the looming threat of punitive action. What was once a stable partnership now seemed fragile and uncertain. The journey from collaboration to confrontation reveals just how quickly international relationships can unravel. As industries and economies are left exposed, the story of U.S. South Korea trade serves as a powerful reminder of the delicate balance that underpins global commerce. In summer 2025, hope flickered as the U.S. and South Korea reached a verbal deal. $350 billion in Korean investment for lower tariffs, but the U.S. demanded the entire sum as a direct cash payment, with no financial safeguards or currency swap. Washington insisted on full control over the fund's allocation, turning the deal into what Seoul saw as a one-sided tribute. President Lee Jae-myung warned this could trigger a financial crisis reminiscent of 1997. Seoul's request for a currency swap was denied, and the risk proved too great. Talks collapsed, optimism vanished, and the failed deal became a symbol of irreconcilable differences. The stage was set for punitive measures and deeper conflict. As diplomacy stalled, a U.S. immigration raid on Hyundai and LG's Georgia battery plant ignited outrage. Nearly 500 workers were arrested, over 300 of them South Korean nationals, none direct Hyundai employees, but contractors. In Seoul, the raid was seen as a political tactic, not routine enforcement, deepening mistrust. President Lee condemned the action, warning it would chill future Korean investment in the U.S. Despite a later apology, the damage was done, trust was shattered, and the goodwill built over years evaporated. For Korean corporations, the message was clear: even massive investment offers no protection from political crossfire. With the $350 billion deal dead and relations between Washington and Seoul at a historic low, Trump's administration doubled down on its America First trade policy. The White House, emboldened by its base and determined to show strength, shifted from negotiation to confrontation. The administration's message was clear: the era of compromise was over, and the U.S. would now prioritize its own economic interests above all else, no matter the diplomatic fallout. In January 2026, the U.S. imposed a sweeping 25% tariff on South Korean cars and a range of other exports. This was not an isolated move, but the culmination of months of escalating threats and warnings. The The new tariffs were designed to send a message to both allies and rivals. The US would use its economic might to protect domestic industries, even if it meant upending decades-old trade relationships. Since early 2025, baseline tariffs on all imports had soared, with the administration rolling out a patchwork of non-binding, country-specific deals. These agreements, often negotiated behind closed doors, institutionalized uncertainty for global businesses. Companies and governments alike struggled to predict what the next week might bring, as the US shifted from a rules-based system to one defined by presidential discretion. Traditional allies like the UK and EU, wary of economic disruption, reluctantly accepted high tariffs and strict quotas in exchange for temporary relief. Their leaders hoped to buy time and avoid a full-blown trade war. South Korea, however, stood its ground, refusing to accept what it saw as unfair terms, and risking the wrath of Washington. The 25% tariff was a direct response to Seoul's refusal to capitulate. For South Korea, the stakes were enormous, as the US was one of its largest export markets. The move was seen as both a punishment and a warning to others who might consider defying Washington's demands. For Hyundai and Kia, two of South Korea's automotive giants, the new tariffs threatened their entire business model. Exporting hundreds of thousands of vehicles to the US each year, they now faced a market where Korean-made cars became suddenly unaffordable for most Americans. Dealerships across the country saw sales plummet, and consumers were left with fewer choices and higher prices. The message from Washington was unmistakable. Compliance with US demands would be rewarded, while defiance would be met with swift and severe consequences. The administration's approach was unapologetically transactional, turning trade policy into a tool for leverage and control. The global trading system, already under strain, was upended almost overnight. Markets reacted with panic, supply chains were thrown into chaos, and the consequences for businesses and consumers around the world were immediate and profound. The world was left to grapple with a new era of uncertainty, as America's economic power was wielded with unprecedented force. The 25% auto tariff sent shockwaves through South Korea's financial markets. The Kospi plunged, Hyundai and Kia shares tumbled, and the entire automotive supply chain was thrown into turmoil. The won weakened sharply, signaling fears of capital flight and economic instability. Investors saw the tariff as a direct threat to corporate health and national wealth. The specter of a 1997-style crisis loomed, just as President Lee had warned. The financial pain was immediate and severe, with billions in value erased in hours. The crisis South Korea tried to avoid by rejecting the US deal arrived anyway, delivered by tariffs and panic. The ongoing US-South Korea dispute is sending shockwaves through the global auto industry, affecting not just the two countries involved, but also countless businesses and workers around the world. What began as a political disagreement has quickly escalated into a crisis that threatens the stability of one of the world's most interconnected industries. Trump's tariffs have thrown just-in-time supply chains into disarray, raising costs and creating chaos for manufacturers worldwide. Automakers rely on a delicate balance of parts arriving from multiple countries, and even a small disruption can halt entire production lines. Now, delays and shortages are becoming the new normal, forcing companies to scramble for alternatives. For American consumers, the impact is immediate and visible. They're seeing higher prices at dealerships, fewer models to choose from, and longer wait times for new vehicles. The tariffs on imported cars and parts ripple through the market, making it harder for families to afford reliable transportation and for businesses to update their fleets. Even vehicles assembled in the US are not immune. Many critical components, engines, electronics, transmissions, are sourced from abroad. As tariffs drive up the cost of these parts, the price of US-made cars rises too, putting additional strain on both manufacturers and buyers. Automakers now face tough decisions. Should they absorb the higher costs and risk shrinking profits, pass them on to consumers and risk losing sales, or attempt the expensive and time-consuming process of moving supply chains back to the US? Each option comes with significant risks and no easy answers. The result is a fragmented, politicized industry, where efficiency and innovation are sacrificed for short-term political gain. Companies are forced to divert resources from research and development to crisis management, slowing progress on electric vehicles and new technologies. While the stated goal is to protect American jobs, the reality is more complicated. Higher costs could make U.S. manufacturing less competitive on the world stage, potentially leading to layoffs and plant closures, ironically putting the very jobs the tariffs aim to protect at risk. As the rule of law in global trade erodes, replaced by uncertainty and power politics, the future of the auto industry, and the millions of people who depend on it, hangs in the balance. Economic friction is straining U.S. alliances and reshaping the global order. The U.S. now demands trade concessions for security guarantees, alienating partners like South Korea. Meanwhile, China, Russia, and North Korea are forging a united front, signaling a new era of strategic rivalry. The world is fracturing into opposing blocs, reviving Cold War-style divisions. Punitive U.S. tariffs push allies to seek stability elsewhere, weakening the coalition needed to counter rivals. A power-based, bilateral world is more volatile, with economic disputes risking security spillover. The true cost of America First may be the erosion of alliances that have underpinned global peace for generations. Hyundai faces a stark choice: stay invested in an unpredictable U.S. market or seek stability elsewhere. Billions invested in American factories and jobs offer no shield from political headwinds. The volatility of America First policies is toxic for long-term planning. Hyundai and corporations worldwide must now factor U.S. political risk into every decision. The global trading system is being redefined, with capital and investment potentially shifting away from the U.S. The Hyundai story is a warning. Protectionism and eroded norms threaten prosperity and stability. The world must consider if fragmented markets and strained alliances serve anyone's interests. The choices made now will shape the economic and political landscape for a generation.